Welcome again to the Risk Awareness Week 2019. Today I will present to you 10 practical recommendations for an efficient risk management program. These have been basically our takeaways that our clients, a customer coming to the ISO 27000 certification session, have been sharing with us, telling us, oh, that's interesting, I will use it in my company. So let me share this with you. First, a few words about me. So I have a strong education in chemical engineer and risk management, 30 years experience in risk-related project and activities, and expertise in industrial risk, yes, civil directive, working with the European Commission, UN, or World Bank. Standards have been always very important for me because that is a very strong basis on which you can basically do things and recommend things. And obviously, the ISO 31000 standard, which is based on the Australian standard, basically have been always attracting my interest. And today, basically, I'm driving the international non-for-profit organization, Global Institute for Risk Management Standard, which propose also, among other things, basically our certification program in 7 languages. So let me show you our current activities, survey, course, conference, linking group, which is quite popular with 65,000 people, certification and link with ISO TC262, the committee of ISO in charge of ISO 31000. The new 2018 version will extend our service for implementation, assessing program based on the risk maturity model. ISO 31000, a few words. If you ask me what happened in the best things that happened in the last 20 years, I will tell you that finally there is a standard that can apply to all sectors, all industries, and more importantly, for all type of risk, and that's ISO 31000. So it's definitely a strong basis for risk management in today's world. Here are my 10 recommendations for an efficient risk management program. First, link with objective, right? And of course, objective can be in conflict. We will look into it. Can I have multiple consequences? And also important is to turn threat into opportunities. You don't run risk management program on negative, on scaring people. Risk owners will be another concept we will deal with, level of risk, of course, and how to present a treatment, a request for budget for treatment. And then we will basically finish with talking about controls, which are usually quite important for people to modify or to reduce the level of risk, and talk about, of course, adequate training. So first, link risk with objectives. So you can see the definition, effect of uncertainty on objective. It is there, very important. That means you cannot talk about risk if you have not defined the objective. This is important because in all the texts along, we keep talking extensively about risk and objective in ISO 31000. So now, what is not risk management? And still many companies are getting confused that risk is not about compliance, control, audit, techniques, or simply reporting or tick the box, you know? So what is it then? Well, this is the philosophy of ISO 31000. Basically, it makes the strong link between risk and objective, and who is there to make objective is decision makers. So basically, now risk management have moved into the field of decision-making series, and when a manager make decision, you always do it under uncertainty. And you follow the decision link on performance, and managers also look at what is the best allocation of resources to basically achieve my objective. So, and what are the other things in gray you can see here? We are tools. For example, compliance are basically risk to be managed the same way as other type of risk. So now, effect of its own objective, we are very clear. We will clearly focus on decision-making, as all along this week in the Risk Awareness Week, we have been talking about decision-making. So again, effect of uncertain objectives. You can see objective with S, so multiple objective. It means you could have a negative impact on different aspects, but also positive impact, right? So that's important. This is a note from ISO 17000. An effect can be a deviation from the expect, positive and or negative. Let's move on. Objective can have different aspects, financial, can apply to a different level, of course, and different scope. Can basically be for a company, an enterprise, a division, a department, a group working on a project or a product, or individuals. Objective of stakeholders and objective of the society as a whole. This is basically depending on which sector you are on, you have to consider this type of objective. Decisions are taken also in different timeline. At top management levels, they deal with strategy, which usually deal with long-term objective. For plans and project, usually is medium-term, and operation is day-to-day basically activities. That means day-to-day sometimes decision. Yeah. So keep in mind, different time period. Now, also, of course, objectives need to be smart, specific, measurable, actionable, relevant, and time-bound. You're probably familiar with this concept of SMART, but keep in mind, because very important, if you set up an objective which cannot be achieved, how do you expect people to basically, be motivated to reach it? Also, if you cannot measure it, so how can you see the progress you have done, right? Okay, SMART. Objective should be always SMART. That's a nice keyword, actually. Another aspect is uncertainty, as we discussed. There is an uncertainty about objective, of course, because that's something about the future. So you don't know whether you can achieve it or not. And decision also are uncertain. Basically, managers have been using the guts. What are my two options? Option A or option B? What shall I do? Uncertainty linked to decision is clearly involved. Context and anything about the future. Now, here I put to you a couple of topics that are also uncertain. The structure, the governance, the data that you are using, are they complete, current, up-to-date, relevant? Modeling also quite important, and you don't know whether this model can be applied or not, so you have to be cautious about using also modeling, right? Cognitive biases, person basically, so when a person take a decision, are you following the group, or is it really what you want, or do you have some kind of hidden personal objective? Yeah, so all of this, there is uncertainty and linked to all these aspects. Second takeaway, conflicting objective. Okay, so do we have conflict in a company? Yeah. Look, I'm sure you have seen this conflict between strategies, conflict between business unit, department, production, IT, HR, internal audit, different objective. So you might have within the same company, organization, or department, different objectives that you want to achieve. So might be competing or in conflict. Allocation of resources. Every manager wants the best allocation of resources for themselves, for basically the product, the project. So the best allocation you have, the more resources you have, the more likely you can achieve your objective. So there is conflict, right? Stakeholder or also that, the view of stakeholders might be aligned with the company objective or not, right? And conflict between individuals, because you might think everyone in a company are aligned with the objective of the company, maybe not, right? Maybe they have their own view and they come here for 1 year and they know they will move on. So, okay, let's have a look in detail. Here is another aspect that every CEO, struggle with. Quarterly profit or long-term strategy. Is it better for me to show a great result and boost shareholder value? Or shall I basically make long-term decisions that might bring result, even after I leave the company. So this is clearly uncertainty and decisions that are top management need to take. And of course, there is also charts, that the big four company have been advising in terms of product, in terms of market. BCG, was very well known in terms of looking what are the product and market you are in it. Another aspect is, as I mentioned to you here earlier, right? So do you need to boost shareholder value? This has been a mantra in many organizations that said the objective of the company is to create value to who? To shareholders, because they are the owners. Actually, this is a very challenging concept. And I'm very pleased because recently, look, August 2019, very big companies and CEO of these companies have been saying shareholder value is no longer the main objective of an organization. So what is it then, the main objective? Well, this is basically 4 objectives that we consider any organization or company, profit or not, have basically. Performance. So what is the best allocation of resources for profit, to maximize profit, or service delivery? And these are in conflict with law and regulation, because the more a law and regulation is basically strict, the more it affects the performance. So there is a balance here to be found, right? Also about CSR, corporate social responsibility. More and more companies basically see value in saying, yes, I need to go beyond regulation. Yes, the regulation imposed to me to do things. Okay, I will comply, but I have to go beyond that. And there are different aspects. Here I mentioned climate change, but as this concept is basically developing a lot, we talk here about climate emergency. And reputation is, of course, another aspect that you have to follow. So these are 4 objectives. Each of them have uncertainty. And I put in green here, basically leadership and the PDCA cycle. That means you can apply ISO 27000 to each of them. So you need to plan, design, implement, and assess, right? So when we mention about conflict between departments, here are some examples. The conflict between production and sales, production and maintenance. Maintenance would like to have preventive maintenance, but if the maintenance is too long, then the production goes down. So you have to deal with this type of conflict. Sales and department and marketing. Marketing enhance a product, even exaggerate the product, and then the sales, cannot sell it because it has been exaggerated, right? Operation and IT, operation internal audit. So basically conflict between departments occur all the time. Also conflict between different type of objective. You might have operation, finance, quality, safety, environmental issue. These are 4 objectives that come all along also when a person needs to make a decision. So what about my constraint in terms of environmental or safety of the people? So don't do anything in operation that might jeopardize the safety of the people doing it, right? What about other conflict? Allocation of resources, as you can imagine, between 2 projects. If project A has the most resources, the chance to be achieved will be higher, right? So that's why there are a conflict between allocation of resources. The same for product or services or planning. If you have a very good planning and you have good resources to do your plan or your task or action, you basically have increased your chance to achieve your objective. Okay, so here are basically 3 main ideas. When you have an objective that you set up, extremely ambitious, very high, and probably costly, then the greater will be the conflict in allocating resources. So be careful here, right? Another aspect when decisions are taken, is it short-term or long-term? There is always a fine balance to be found for every decision at all levels. And the third one is the only option to manage this conflict is through management of risk. You know, basically said, why shall I do risk management? Well, if there is one reason is you need to manage this conflict of objectives. So definitely use risk management. Third takeaway, multiple consequences. So here is a reference of ISO 17000. It talks about more than one type of outcome and a variety of consequence. So what are we talking about? So basically, a consequence can be certain or not, positive or negative. Positive for one particular objective and negative for another, right? Can be direct or indirect, quantitative, qualitative. Categorization also important. So we will basically look at all these aspects regarding consequence, because when a decision is taken, the manager should be aware of the consequence of this decision, not only for you, but also for others, right? So differentiation of impact, cascading effect, different time, place, group, or situation, and sensitivity to preconditions. What is the confidence level you have regarding a particular consequence? So here is the definition of consequence. Outcome, an event affecting objective. And remember, event, it's an occurrence or change of circumstance. So a consequence is outcome of a change of circumstance affecting objective. So, and here are a few notes that you can consider. Quantitative, qualitative, this is nothing new, but it's good to have a quick reminder, you know, different ways to look. And if you can, privilege always quantitative consequence. You know, you need to measure. Remember what we said about SMART, objective, measurable was the M. Yeah. Okay. Range of level of consequence. Yeah, consequence can have, you know, impact on the strategy, on tactical, operation, or execution level. Nothing new here, but it's good to have this kind of categories. Position. One consequence taken in one department or one division can have an impact to another department or another division. So I'm just basically giving you here a quick flow chart, and eventually the human resource might be affected for decisions that you take at operation, for example. Yeah. Another aspect is impact. Okay, here we talk here about modeling. You can have a continuous distribution, and I really encourage every people dealing with management of risk to have knowledge in statistic, probabilities, investment, you know. So this is a tools that are very useful to have a strong credibility, you know, whenever numbers you propose. Modelization can be from a sample and then you convert into, you know, a curve like this. So again, modeling. And decision tree is very common, but it gives you a good, quick way basically to make decision. But here are just some example of range of impact. Yeah. Another way to look at range of impact is, let's take an example of fire, which can be small, medium, or even catastrophic. Okay, never happened, but you still need to consider. So small fire will be managed by 45 people in operation. I said we've been managed. Yeah, of course, risk owners are those who are managing risk. Yeah, so in the department they will deal with medium fire, mainly because those in the operation might not have the budget enough to buy control, you know, to handle a medium type of event like medium fire, right? And of course, if there is a major catastrophic event, that the stock management will basically deal with this. So you can see, yeah, remember, whenever you consider an event, the impact of an event, well, this impact can be small, medium, or catastrophic. Categorization also important aspect. You know, I put here a few examples that I've seen. You know, property damage, impact to people, financial impact, liability, reputation, tactical, operational strategy, medium, low, high, basically. So here are different categorization. Again, you need to find the best categorization which is useful for your organization. Yeah, so there is nothing recommended as such in ISO 27000. Cascading effect, also quite important, because as you see here, I just took an example of a chemical process where we produce PVC, yeah, plastic bag. And you can see this process to produce this plastic bag is very dangerous. It can have all along the process the risk of fire, explosion, or even release of toxic gas. Again, the chemical and petrochemical industry is fully aware of this cascading effect, which you might not, you know, so always consider what might be the domino effect, you know, of a decision or a consequence that you are considering. Another aspect is about the sensitivity to preconditions and the confidence level you have. So if you want to put just a number, you know, it's not good enough. You have to say how this number, how confident you are regarding this number, and you have 1, 2, or 3 sigma confidence range, but you can have also do a sensitivity analysis where you basically test your hypothesis, your assumption. You can test it, and then you can see how the outcome change. So that's what we call sensitivity to preconditions. Number 4 recommendation. As I told you before, you don't run risk management to be efficient, like said, you must do this. You have to fill in this form, you know. If you don't do this, we will have this major risk that will impact, you know, and you will be blamed. That's not the way you run risk management. You need to convince managers to, you know, to use the management of risk as a tool to help them to achieve their decision. So turn the threat into opportunities. It really depends how you present it. ISO 2000 really encourage, you know, to find relevant get to improvement opportunities, you know, in a clearly positive way. So in ERM and still in many organizations, they talk about what I mentioned here, traditional risk management. So they look at the negative part only, possibility of loss and accident focus, when in fact you should see the overall value of the organization. You know, you have to look at the organization as a whole, so with the possibility of loss, of course, or no loss, but also possibility of gains. That means business risk. Yeah. Definition of risk is here a quick reminder: effect of entity on objective and different type of impact. So what is the use of risk management at different level, as we mentioned earlier, but the benefit. Let's have a look now to the benefit. How can you convince managers that they should apply, that risk management will help them to achieve the objective, will help them to have risk-based decision? Well, it really depends on who you have in front of you. And the arguments that you might use with a person in operation might not be exactly the same argument you will use for a person in finance or those who are dealing with health and safety. So here are some buckets: overall management, financial performance, reputation, compliance, reducing losses, and governance, that I put basically in main categories. And we can see here in detail for each of them, what is the benefit? Look at the first one, reliable base for decision-making. Have you noticed that in many organizations, managers are afraid to make a decision because he's afraid to be blamed? Or if there is a bad consequence, the internal audit later on will say, well, you see, you took a bad decision. No. So managers need to feel confident on which basis you have taken a decision. And that's what risk management basically can do. being proactive, help to increase the likelihood to achieve your objective. Okay, many aspects to increase overall management. Again, find the right argument for different people you have in front of you. Better financial performance, and people in finance will definitely see interest in this. Credit rating, standards and pros. I've introduced risk evaluation for the credit rating estimation. So that's, you can see now it applies not only to financial company, but also non-financial company. So risk management is really here everywhere. Yeah. Reputation, of course, critical assets that need to be managed. Respect law and regulations. This is health and safety, environment, reporting, mandatory or not. Reducing losses, of course, improve loss prevention, losses, fraud, resilience. Here we talk here not only about business continuity, but also resilience. So for major disruption, business continuity. For resilience, it's a small, interference that you might face, and the organization need to be agile. That means to quickly come back to the level where it was. Yeah, that's what we call also incident management. Okay, governance, also an aspect very important. Remember, governance in our definition is to provide assurance that the management is basically that the company is well managed. So governance is to provide assurance to stakeholders that the company is well managed. And of course, risk management is part of governance. Yeah. Internal control, again, we have to find the right balance between control and performance. We will talk about this later. Number 5th takeaway, everyone is a risk manager, is a risk owner, sorry, very important. So what is the definition of risk owner? Well, ISO 17000 mentioned it's a person or entity who has the accountability and authority to manage risk. Who is this? Well, it should be someone accountable, right? Now, what does it mean accountable? Is it the same as responsible or liable? No, here we use the word accountable. That means if a person responsible is the one doing the job, right? If the job is not done or not well done, you will need to blame someone, well, to basically address someone, right? And that's the person accountable. And liable, of course, you have legal consequence. So a risk owner who is basically a manager, he is basically accountable. Now, what does it mean, accountability? Well, in our explanation in our course, we said you can be accountable only if you have the authority, the resource, and the competence. And I'm sure you have seen in your company, people who have the authority and the competence do not have the resource. Or you have a person that has the resources and the competence, but always his boss is interfering. That means there is a confusion authority. So to have a person to be considered as a risk owner, you must have these 3 elements together: authority, resource, and competence. And that's very important, because if something happens and you don't have the competence or the authority, you will be blamed. And in fact, you should never accept to be a risk owner if you have not these 3 elements. Okay? So here, giving you an idea that, of course, a risk owner is not a risk manager, because a risk manager is the one providing help to managers to make risk-based decisions. So it's a facilitator, it's coordinator. So now a risk owner must have, as we said, authority, resource, competence. Look at this chart. At the bottom, we see the guy in circle. Basically, he doesn't have the authority, the resource, and the competence for one particular risk. So what happened? It escalated to his boss. who also do not have the resources. So it went up again until the person in green, which has the three elements, authority, resource, and competent. Very powerful concept. And once implemented, you know, basically it adds a lot of value to an efficient risk management program put in place. All right? Another takeaway is about level of risk. Is it the same as the cost of risk? Okay, so let's have a look to the definition of ISO 13000. So level of risk, magnitude of the risk, or combination of the consequence and their likelihood. Okay, so that's the definition. Now, what's the definition of consequence? Here, a quick reminder: outcome on event affecting objective. Remember, outcome of a change of circumstance affecting objective. What about likelihood? Chance of something happening. But what is this something? Why is it put this word something? Is it a chance of an event happening? Or is it the chance that this level of impact, this level of consequence will occur? Well, actually, it can be both. Yeah. So you have to always to specify, are you talking about the likelihood of the event or the likelihood of the consequence? Here's an example to explain the concept. Here, I give the example of fire that make it easier for everyone to understand. So again, it can be small, medium, and far catastrophic, different level of consequence. What is the likelihood? Well, my statistic tell me that I have 10 fires per month. It means within a year, it's likely, my likelihood of this event to occur, I will have 120 fires that will start, with a cost, average cost of 12,000. This is what we call the cost of risk. Now, if I have a fire, what is the likelihood that it will cost me $100? Well, then people might say, yeah, most of the time, yeah, that's why I put 99%. It means if I combine the two, it's $99. This is what we call the level of risk. And you can basically apply the same logic, you know, for likelihood. Let's say one time I had a medium fire in the last, within a year. I mean, that's what my statistic is telling me. That this is the cost. And what is the level of risk of medium fire? 1,000. You can see the numbers are very different. So you have to be always very clear about what you want. When people need to report, what is the exposure? What is the level of risk, right? So be sure you don't confuse them with the cost of risk. So in summary, the cost of risk is a consequence times the likelihood of the event, which is useful for budget. And the level of risk is to basically useful to estimate the exposure. I focus on this. However, in the new version of 2018, there is less focus on this concept of level of risk, but still very much used in many organizations. That's why I want to put this clear. Yeah. Another topic is present treatment as an investment. This is also important because when you have identified, analyzed, evaluate, you decide to go for treatment. That means you need to request a budget. You will need to ask the CFO or the person in charge of finance to allocate money to you, and you need to present it. Don't say it's because it's for compliance, you know, most of the time it's not the case. So you need to justify on which base you request an investment. And the ISO 13000 clearly mentions that this is what you should do. Yeah, balancing benefit and cost, effort. Okay, so let's have a look in detail. Always present your expenditure in risk management as an investment. How can you do this? Because investment is allocation of resources, which can be time, people, money, but you have also constraint, right? Existing resource might be limited, right? So keep this into account. But still, you have to give a proper argument when you request an expenditure for risk management. Cost-benefit analysis, here are some aspects to consider. Of course, the cost of the controls that you want, the cost of the treatment plan, you need to some time of timeline to basically put in place. It will have also an impact on operation during the treatment plan, impact on performance. The more control you put, the more you impact the performance. This is a very clear concept. Many internal auditors are not clear on this. You know, you cannot put a control, an additional control, and another one without looking at what is the impact on performance. Also, a control that you want to put in place might create new risk or modify existing risk. This is a cost. You might call it a secondary risk, but still you need to include it in the cost of the new controls that you are considering. And of course, the benefit, reduction of the potential loss, and the positive impact that is usually not included, and you should, okay? If you can measure, of course. Now, this is something that I still don't see enough in many organizations, that when we talk about you need to request a budget for implementing a new control, there are techniques that exist. And those who have a curriculum in project management know this. Here are 3 techniques, as just a quick reminder, because that's very basic. You need to give, for example, using the concept of rate of return. What is it? Well, you can take what is a potential loss that you have after and before treatment. And of course, you have to show that you reduce the potential loss by so many %. Yeah. So this is the first one. The second one is NPV, net present value. So what is a net present value? Okay, so in short, this is the difference between the present value of future cash flow coming in and the present value of future cash flow coming out for a defined period. This is very useful because it basically compensates, you know, the limitation of the first method, right? Another aspect to consider is a method 3, is to basically consider that you need to look at an internal rate of return that should be bigger than the WACC, which is a weighted average cost of capital. So what are we talking here about? Well, if a company, well, let's say I have $100 that I need to invest. I can invest it in a project, or I can put it in the bank that might give me a return of X%. Or I put on the financial market that will give me a return of X%. So this X% is what we call the WACC. That basically any project or an investment you consider should have a profitability that should be higher than the internal the WACC. So the internal rate of return should be higher than the WACC. Okay. So just a quick reminder, the first method is very simple, and that's also the inconvenient, you know, it's very basic also, you know, and very, so, and it's only valid for 2 dates. It's quite punctual, and you cannot use it to compare 2 projects. You know, when a manager is taking decision project A or project B, which one to take, I cannot use the rate of return method. It's better to use NPV. So NPV, if the NPV is positive, basically it will tell me, okay, this project is profitable. And you can look at profitability for multiple years. And basically it look at the time value of money that future income will give you at the moment when you are going to take a decision. Okay, inconvenience, because they are also inconvenient, is you make many assumptions, not only about future income, which are quite uncertain, but also for future expenditure. And you don't know what the future reserves to you, so it might not be good for a long period. And you cannot, of course, well, you cannot compare project. You can only say that a project is profitable or not. That's it. Now, if you want something more advanced, of course, you need to use internal rate of return. What is it? It's a matrix to basically use for capital budgeting to estimate the profitability of a project or an investment. So in fact, the internal rate of return is a discount rate that makes the NPV, the net present value, for a particular, for all cash flow linked to a project or investment equal to 0. If this is too complicated, but really, make some inquiries, because these are the 3 basic methods, for capital budgeting. Number 8 takeaway: control affect performance. And that's what is clearly also mentioned in ISO 17000. Control may not always exert the intended or assumed modified effect. So what are we talking about here? Remember what I mentioned to you about the benefits of risk management. So improve control that need to be effective and efficient. Basically, you always need to see whether a control makes sense, whether it is there to achieve particular objectives that you want to control, in bracket, with the best allocation of resources. That's basically the idea behind this. Yeah. So another aspect is about new controls also, modify existing risk or even create new risk. So again, it's clearly mentioned in ISO 17000. So it has a risk treatment might have produced unintended consequence. So unintended consequence might be modify existing risk or create new risk. And here are basically the idea behind that. You need to look at what basically a new risk might be created. For example, you are dealing with a risk of fraud. You are putting in the IT system, forcing everyone using the computer to change the password, let's say, every 2 weeks. It became a burden. So what are people going to do if they need to change the password every 2 weeks? Which is IT have imposed as a new control, and you must change it, right? You are going to use a post-it and put it in your laptop, for example. So you basically increase the risk of your laptop to be hacked because the password, you have been putting somewhere where you want to remember. So remember the right balance between control and performance, and also control might create new risk or modify existing risk. Last one will be adequate training. Still, I see many people who become risk manager or head of risk or in charge of managing risk in the organization because they have a background in health and safety or project or insurance, but still do not get a proper, adequate training. Don't get me wrong, I think today there is no excuse. There is an international standard for risk management. You can read it by yourself, of course, but if you want to have in-depth knowledge, get adequate training. So why is getting certified with us? Well, we have been there since 2012. So it has been already 7 years, and our courses are in multiple language. ISO is a very strong basis on which you can basically recommend things linked to risk management, and that will make your program more credible. And credible means effective and efficient, as we said. Yeah. So we have basically a large network of trainers worldwide. Our course in English, French, Spanish, Italian, Dutch, Russian, and Portuguese. So 7 languages. If you want to plan when and looking at what are our courses, have a look to the website. And here our structure of courses. Foundation, you are certified ISO 27000. So if you want to become a trainer, you could basically take different exams and we can go for validation to be certified trainer. And now we have an advanced course for lead assessor because we have developed a risk maturity model, which is a very strong base on which you can assess a risk management program. And of course, option for ISO 27010 on technique for risk assessment. Network is quite large, not only with trainers, but also with professionals. Many organizations have basically been trained through us. And our network is growing, and that is a future chapters that we will put in place. And here are the key contact point, in different regions. Courses, we have conducted many worldwide, and you can plan even your survey, sharing with us when and where you would like to basically to be propose such a training. Take this link on survey. Many companies have been trained with us, so I'm very proud. We have reached now close to 900 different companies. It's quite amazing, and among them, the major one. Yeah, you can see here. You have a look to the website. Here are the upcoming courses, and don't forget, this international ISO certification will be give you credibility and a good in-depth knowledge of the content of ISO 27000. So thank you for listening to this session. Here is a quick reminder of the 10 recommendations that I was going through. You can replay basically this video, and if you are comfortable with the concept I've presented here, you are quite suitable, basically to join our training and get your ISO 31000 certification. So thank you for your participation, and see you soon to one of our events. Thank you. Bye-bye.